Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about how to swing trade for beginners. Now, this is a method that captures price movements over several days to week and can enhance your trading results. You would learn exactly what swing trading is, the core indicators and concepts you will need to understand, and a straightforward step-by-step strategy you can implement right away. So by watching through to the end, you will gain the knowledge to identify reliable trade setups, manage your risks effectively, and place your first swing trades with clarity. We start by understanding what swing trading is about. And swing trading is a method of capturing intermediate term price movement that unfold over several days to weeks to a few weeks. You aim to buy near a pullback low, and sell near a swing high, balancing patience with disciplined risk management. Basically, this is what it means. Swing trading using a higher time frame, you buy during a pullback phase so that you can catch this move to the upside. In a selling phase, for instance, you sell during a pullback phase to catch this move on the higher time frame. Now in the chart, you can see the price moves in a wave-like motion. If you can see from price moves in a wave-like motion, and it initiates rally, a retracement, then a new advance. As you can see, a retracement, then an advance. As a swing trader, you will look to enter after a pullback and exit before the next major reversal. You don't need to monitor the market every minute. You don't need to monitor the market any minute. Instead, you set alerts at key levels and let the setup develop. Now, the main elements of swing trading includes identifying the overall trend so that you can trade in the direction that increases your chance of success. The second element would be spotting pullback or retracement within the trend, which can often lower risk entry points. Now, the third element we need to apply would be using technical indicators such as your moving average. You can use your moving average to or momentum tools to confirm your trade ideas or the direction of the market. Now, the last step would be to manage risks carefully with stop loss orders to protect your capital. When these elements work together, you will have to have a repeatable framework, which is to spot the trend, wait for the pullback, enter your stop loss, and take profit at logical levels. Now let's see a step-by-step trading approach. Now that you know the four core elements of swing trading, which is identifying the trend, exiting your trade, your entry timing, and your risk control. We're going to assemble them together into a clear step-by-step approach that you can use in every setup. Now, the first step would be your market selection. Now, before you place any trade, you have to choose a particular asset with sufficient liquidity and volatility. Now, in Forex, that usually is a major pair, and the major pairs you would come across would be your GBP USD or your Euro USD. Why? Because they have tighter spreads and a steady volume that lets you enter and exit the market without slippage. Now, if you want to try and trade stocks or ETFs, you would have to focus on names with average daily volume over 1 million shares and typical price moves of at least 1.5%. Now this ensures swing are large enough to cover trading costs and yield meaningful gains. So it's always preferable to make use of major pairs because you are not going to pay for high trading costs or larger spreads. It's always advisable to use forex main pairs. Now the second step would be to identify your trend. Now to identify your trend, you would have to use your daily chart as your primary time frame, and as you can see, my chart is on my daily time frame. This would be my primary time frame. You have to confirm with your 4-hour chart. First of all, you would have to plot a 20-day and a 50-day moving average. When the 20-day sits above, so plotting my 20 exponential moving average and my 50 exponential moving average. The 20 exponential moving average is this blue line, while my 50 exponential moving average is the yellow line. All we need to do is when the 20-day moving average sits above the 50 moving average, meaning when this blue line crosses above this yellow line, you would need to know that we are in an uptrend, while when the blue line sits below the yellow line, it means that we are in a downtrend. We can also make use of the relative strength index when it's above 50 to confirm a valid uptrend, and when it's below 50 to confirm a valid downtrend. These are the indicators you can use to confirm the direction of the market. Now the third step would be to set up your entries. Setting up your entries within the trend, you have to wait for a pullback. You wait for a pullback to a key support in an uptrend and a resistance in a downtrend. Or you can make use of your Fibonacci retracement tool. You draw it from your swing low to your swing high. Then you watch out for levels such as your 0.38 level, that's your 38.2 level. You can watch out for your 50% level and your 0.618 level. These are the levels that when price gets to, you are expecting a reversal from that area. Remember, you are trading based on the waves of the market. You can see this is a swing high, this is a swing low. When price retraces to at least 50% or 38.2%, those are the areas you'll be looking to enter a sell position on your swing trade. As you can see, after price made a series of swing high, a swing low, a lower high, a lower low, this current lower high that price was about to form, when you draw your Fibonacci extension from the swing, from the lower high to the lower low, where price gets to the 50% or 0.38 level, you would have to watch out for your candlestick formation at those level. Once you see your confirmation, those are the areas that you can enter your trade. You can also switch to your 4 hours time frame to look for a clear reversal candlestick pattern. As you can see at this particular area, let's mark this area out in chart. We'll look for a clear pattern on the 4-hour time frame to further illustrate our trading idea and our trade sample. Now as you can see at this area on the 4-hour time frame, when price got to our 50% level, you can see that price created a bearish engulfing candle that engulfed 1, 2, 3, 4, 5, 6, 7, 8, 8 candles. It engulfed 8 candles, which shows that yes, at this particular area, price was about to reverse to the downside. This would be a good area to enter your sell trade. You can also look out for candlesticks pattern such as your hammer, your shooting star at resistance or at support around your entry zone, areas that you're expecting price to reverse from. Remember that Fibonacci level acts as resistance and as support zones on the market. So when price gives you your reversal pattern at these zones, at your area of interest, you'll be looking for opportunities to enter the market. Now the fourth step would be to place your trade, and to place our trade you have to set your entry after you have seen your confirmation. Remember, do not forget to put your stop loss levels. You can also enter your trade using limit orders like stop limits and buy limit. You can use stop orders or buy stop or sell stop orders. You can use those orders to take trade. Remember, in a sell trade you put your stop loss just above your most recent swing high. Those are the areas, or above your resistance zone. Those are the areas you put your stop loss, and in a buying trade you put it below the most recent swing low, or you put it just below the support region. You can also place your stop loss just beyond the most recent swing point. You can also use 1.5 times average true range to account for normal volatility. Remember, size your position so that a stop loss cost would not cost more than 1 to 2% of your trading capital. Your total capital, you don't risk more than 1 to 2% of your trading capital. The fifth step would be to define our profit target and risk to reward. When setting a trade, it is also as important as setting a stop loss to set your profit level. You have to target at least 1:2 risk to reward ratio, minimum of 1:2 risk to reward ratio. So you time your trade once you believe it's at least 1:2, 1:3. These are the areas that you should be looking to allow your take profit to hit. You can also make use of Fibonacci extension levels. You can use your Fibonacci extension levels as your take profit area. You can remove half of your trade, your profit at this area, and allow the rest to run while letting the rest run. You save up, you take 50% of your original position and let the rest run. Now the sixth step would be to monitor your trades and adjust your stop levels. You'd have to review the trade once or twice in a day, because you are swing trading. Do not forget, this trade would run. If you can look at the distance from when we took the trade to when it got to our stop loss, you can see that it was about 13 days. So within these 13 days you would have to be adjusting your stop loss, or you can refine your trade stop loss entries according to how your indicator shows you, or you can put your trade on break even when you believe price has moved far in your direction. This is basically what you mean by monitoring your trade and adjusting the stop levels. You can also use a trailing stop loss to help you secure profits as price moves further in your direction. You can also be you have to also stay aware of scheduled news or earnings that could trigger sudden moves and trigger your stop if needed. So you have to monitor your charts for most of these reasons. The seventh step, the seventh and the final step would be to exit the trade and conduct a review. Exit when price has reached your final target or show clear reversal signals, such as break of trend line or when the RSI crosses below 50 in an uptrend. You have to log every trade in a journal, both your entries and exit prices, reason for the trade, outcomes, and any emotion notes. Review your trading journals weekly to spot patterns and refine your trading rules and strengthen your discipline in your trading journal. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.